You're 25 minutes away from our shocking stat, 30 minutes from Aussie Jurek, but right now it's time for our quote of the week. I thought this was in celebration of the upcoming $28.5 billion deficit in the coming fiscal year. It's about $115 billion in new deficit spending. That includes this year in the cumulative deficit over the next over a 5-year period. So that's the context of our quote of the week, courtesy of American politician. He's a writer, accountant, college professor, lawyer, Richard Lamb. Christmas is the time when kids tell Santa what they want and adults pay for it. Deficits are when adults tell government what they want and their kids pay for it. One more time. Christmas is the time when kids tell Santa what they want and adults pay for it. Deficits are when adults tell government what they want and their kids pay for it. Very pleased to welcome back to the show Aaron Dunn. You know him from Keystone Financial. Very glad to have him with us again. Aaron, thanks for finding time on the weekend. And, you know, the question hasn't changed. Despite the fact, I was just talking to Kyle Green about this, we're seeing an edge up in U.S. interest rates. Certainly nothing sufficient to really satisfy people's needs and wants for a better yield on investment. I mean, what's this environment like for you right now?
Well, the environment, it really hasn't changed that much, and like I say many times to my clients, we've seen this cycle come back and forth over the past 6-7 years, where interest rates start to go up. People, either get excited about that or afraid of that, depending on what side of the fence they're on, and they start adjusting their investment strategy based on where they think interest rates are going to be a year from now, and we just have not been doing that. It really does not matter what happens with interest rates over the next couple of years with us. We are looking for profitable businesses that are growing, that are paying an income yield or a dividend, but that are growing that dividend. And that's something that a bond does not do. It's when you purchase a bond, generally it's what you see is what you get. You're going to get that small little income coupon, and it's not going to grow from there. So we are investing for yield, but we are primarily, us outside of the yield, outside of the dividend, what we are investing in is a solid growing business, and that's what's going to generate the investment return for our clients and for other investors. So that's what we're focused on, and we're still seeing opportunities out there. They're finding great opportunities in this market is not always easy, but they always come up because things always change, investor sentiment changes, and there's always opportune periods of time where you can find high quality companies, and you can get those companies at a reasonable price, and that's what we're continuing to do. So we continue to be optimistic.
Yeah, one of the things, by the way, you guys have coming up is a do-it-yourself stock investment seminar. And you're talking about how people literally, and whether they ultimately do it themselves, it gives them the tools to kind of think about about their investments. And I'll just remind people, it's coming up on April 4th at in Vancouver at UBC's Robson Square, and you're also doing it in Calgary at the Canoff Conference Center. Yeah, that's correct. Calgary on April 11th, so the following week. And so I mean, this is the kind of thing that you're going to be dealing with, though, is what I'm getting at here, is that at least, as I say, whether you end up doing it yourself, you need to be armed with some of the questions and what you'd look at. So one of the ways you're dealing with, potentially, a bump up in interest rates, I mean, as I say, we've had this huge, whatever number of years it is, 35-year decline, is by finding growth stocks. You're not worried about being in things, so you want your dividend, rather, to be able to grow, as I guess was what I'm saying, to compensate for that change in interest rate environment.
Yeah, exactly. And I mean, one way to look at it as well, a way that we look at it is you're getting a nice yield from a stock, but if you're holding that stock for a long period of time, inflation would eat away at the value of that dividend if it's not growing. So, we want to see at least compensation for inflation, but in most of these cases, the companies, these growth stocks that we're investing in, we're getting more than just inflation. We're getting a business that's actually growing value and then sending that value back to shareholders in the form of a dividend. But I'm glad you brought the investment seminar up, because it's something that we are really excited about right now. It's people have been asking us for this for years, and now it's finally happening. And what we're going to do is we're going to break Keystone's investment process down into very simple and easy to implement principles and teach people things like how many stocks to own in the portfolio, what to look for in a stock to buy, signs that you should sell, and signs that there are certain situations that you should avoid. So it's going to be very interactive as well. Lots of opportunities for investors to ask us questions and clarify details. And we're encouraging people to even send in companies that will, or bring in company names, and we'll do analyses right there on the spot to just show people how we break companies down and how we look at them. And the whole idea here is that we want to empower people. We want to give them the tools so that they can take more control over their own financial future. And, you don't necessarily have to be a professional analyst to do that, but in investing, a little of the right knowledge goes a long way, and that's what we're going to help people do.
Let me just, I'm going to give you a chance to give me an example of this, because I was looking back on stuff that you've recommended on Money Talks and at the World Outlook Conference. So I'm going to give you one name. I love the company, Brookfield Infrastructure. The symbol, by the way, is BIP, Bob India Peter.UN. Okay, so I looked at my notes. You recommended this, I think it was about 5 years ago, right around now. It was March, I think, of 2011, stock trading, let's say about $15. Okay,
yeah.
It pays its dividend. It's done well. I want to know, do you get out of that stock? Well, first of all, what is the current price? Something like $50 right now?
Yeah, $50 is the price right now. You're right. We recommended it in 2011 at just over $14, about $14.50 a share. It depends on what is driving the share price appreciation. In the case of Brookfield, what's been driving it is success in the business, is growth in the underlying cash flow and in the dividend as well. So if you look at the company today, it's trading at a valuation of just over 14 times cash flow. So it's not super cheap, but it's reasonable because it's a company that it's a highly stable business, global infrastructure, long-term contracted assets with inflation indexation, and the valuation is actually not much more expensive than we originally recommended it at $14.50, and it's really in line with what it's been trading at historically. But I did some calculations on this, Michael, and I've been doing this with some of the companies that we've had under coverage for 5, 6, 7 years. And over the 6-year period, Brookfield has actually paid investors $6.88 US in income distributions. So we recommended it $14.50 Canadian, and investors that have owned it over that period have gotten $6.88 US back just in income distributions. On top of that, the share price or the unit price is up about 250%. So, but to answer your question, they just keep investing back in the business and they keep growing free cash flow, and we like it. Not for something to buy for the next 2 months, but if you want to buy something like this and hold it for the next 2 or 3 years, we think you're going to continue to do really well in this name.
Yeah, it's really interesting because that's one of the challenges for people. Obviously, this is simplification, but it's what to buy, but when to sell. And that's why I found that one interesting, because I'm looking through this and I'm thinking, there's a tendency to say that has gone up so much, I got to get out of that thing, lock in the profit, and I'm assuming that we don't have some special circumstances like you need the money for something desperate. But it is interesting to hear you say that the valuation, when you looked at the quality of the business, the size of the business back 5 years ago, but it's grown commensurate with the share price. So the valuation isn't much different.
No, that's exactly it. And that is what you need to. That's two different situations. You can have a situation where a company is up 250%, and that's driven by a valuation expansion. So maybe earnings have grown a little bit, but really, your price to earnings valuation is what has moved the stock higher. In that situation, that's where you really have to look at that and say, okay, the share price has moved up a lot. Maybe it's now time, depending on the valuation today, that I should take partial profits at least, or all profits. But if you're looking at a company where the share price appreciation is driven mostly by growth in the underlying business, the valuation is still reasonable or attractive, and you still see a solid growth profile going forward, you don't necessarily have to take profits on a company like that. You can keep you can keep holding it. In some cases, keep buying it. You don't want to let one company account for too much of your overall portfolio, but there's no reason if a company is continuing to succeed in what it's doing, there's no reason to sell it based on the fundamentals. And these are exactly the things that we're going to go over at the workshop as well, is to teach people how to look at different situations and determine what is the best step to take in terms of buying or selling a company.
Well, it sounds like just a great idea, by the way. I mean, I'm obviously I wouldn't be doing this show and wouldn't do the World Outlook conferences if I wasn't big on education that way. But all you have to do, by the way, is go to keystocks.com, www.keystocks.com, and they have a button you can click on there for the do-it-yourself stock investment seminar, which is, as I say, I just think it's really valuable information. And Aaron, you know me, this is where I say you got to bring a young person with you. God, this is, I hear so many times, you have no idea how often I hear people saying, I wish I knew this 20 years ago. I wish I knew this 30 years ago. I mean, it's never too late to learn it, but man, it would be helpful if you got it early.
Exactly. Keystone's been doing this for 20 years, so why not benefit from that experience, from the things that we've learned over 20 years? And that's exactly what we want to do. And it's great to see young people at these conferences and at these workshops actually learning, and it's a great opportunity for them.
I got to take a break here. I'm going to come back. I'm going to give you a warning, Aaron. I got a couple of other names for you. One name also that you recommended 6 years ago, and I got to get an update on that. Again, I'm still looking about, why did you buy it, but why would we still keep it, or why would we buy it today, if at all? I'll do that with Aaron Dunn when we come back right here on the Money Talks Network. You're 17 minutes away from Ozzie Jurek joining us, and I've got a test question for you, because I don't think you're ever going to get this one. What was the strongest housing market in Europe in 2016? Strongest housing market in Europe. As I say, you start guessing now, I don't think you're going to get it. Joining me on the line right now, I've got Aaron Dunn, Keystone Financial. You can find them at www.keystocks.com. Aaron, I want to ask you about a couple of other situations. One, for example, the Exchange Income Corp. First time I saw you recommended that was on this show 6 years ago. I'm choosing ones that are March ones, but 6 years ago. I think the stock was about 14 and a quarter. My goodness, has it ever shot up since then? It's $39 when I looked on Friday.
Yeah, absolutely, and it's a company that we still like going forward too, because it's another example of a company where share price appreciation has been driven largely from growth and underlying free cash flow, and the valuation has become more expensive since our original recommendation, but it's still very reasonable, about 12 times free cash. And I did a calculation on this as well, Michael, and we recommended it. So 2010 is when we originally recommended the company. It is paid out at, like you said, $14 and change. It has paid out $11.93 in dividends over that period of time. So basically almost paying back its purchase price. And the reason why that's important to talk about is because it really shows the power of a good dividend growth story. It really shows, and it shows that this is a company that is actually concerned about giving value back to their shareholders. So if you're somebody who's been holding the stock for that amount of time, you're basically playing with the house's money right now. And you still have a company that's growing, that has a solid yield, about 5.4% today, and they're continuing to grow their dividend on an annual basis and do things like reinvest back into the company to generate great organic growth and to look for accretive acquisitions to roll into the company and grow the dividend further. So it's one of those names that we liked it. We liked it 6-7 years ago. We continue to like it today. I would take a 2 to 3 year outlook on the company, not a 6-month outlook, but it's something that we continue to like for sure.
I got to come back to this though. It's like reiterate why you wouldn't sell it today. I mean, why when you buy it at $14.50 or something, and now it's $39. I mean, why is that a buy today, or do you think it is a buy, or is it just a hold, or is it grab your profit and run?
No, it's a buy today. It continues to be a buy today for people that are looking to hold it for 2 to 3 years. There's going to be some volatility in the interim, but really it comes down to valuation. So you look at a company like this, it's paying a nice yield, it's growing that dividend, very nice payout ratio, about 60% right now. Like I said, 12 times free cash flow valuation, record performance last year, record performance the year before. So you compare that. Forget about what it's done in the past. The past really is the past. You look at what the story is today, and you compare that to what else is available on the market. And when you do that, it compares quite favorably, and not just relative to what the market is offering today, but relative to what you typically see in terms of price to cash flow valuations for companies with this type of a growth profile.
What kind of yield does it still have?
It's 5.4% today.
Okay.
Is what it's yielding. So still a nice yield, and they They've increased the dividend twice over the last 12 months. It's up about 10% over the last year. So we expect that to continue over time as well. Like I said as well, 60% payout ratio, so reasonable payout ratio. They're not stretching that free cash flow to pay the dividend, and that's something else that we really like to see. But this company, the ultimate strategy of this company is to make acquisitions of profitable businesses for reasonable valuations that they can roll into their company, and that's what they've done to drive the majority of their growth in the past. You're going to have times where it's more difficult to make large acquisitions because of pricing out in the market, and I think that's something that we're dealing with right now, but they're still making small acquisitions. They're still investing back in the business and growing, and there's always that potential, and eventually I'm very confident that it's going to happen. There's always that potential that they're going to see that big elephant to acquire, and that's going to mean a big step up in free cash flow. So it's the type of story that we like to be with.
Exchange Income Fund, by the way, Income Corp, rather, EIF is the symbol. Okay, you got about 2.5 minutes. Give me something else that you're looking at these days.
Okay, so I'm gonna do something a little different. It's Meritage Hospitality Group. The symbol is MHGU. This trades on the OTC Bulletin Board in the U.S. for about $13 per share. It's from our U.S. growth stock service, and it's part of our Discovery portfolio. So these are high growth but higher risk microcap stocks. Why do we like the company? Very simple business. They own a network of 200 Wendy's restaurants throughout the United States. The strategy is to acquire new restaurants where they can increase sales through renovations and profitability through integrating into their IT system. In 2011, they did a 5-year plan to grow the number of restaurants from 90 to 150. They exceeded it, and over that period of time, they more than doubled their operating earnings, and the share price increased 450%. So now, starting this year, just this year, they've initiated another 5-year plan to bring the number of restaurants to over 300. And just a month into this plan, they've already signed agreements to acquire 67 new restaurants. So we're very confident that they're going to exceed this target once again. They do pay a small dividend. It's not really an income stock right now, but we're also looking forward. They've increased the dividend, and I see that continuing. So I'm going to reiterate, it is certainly higher risk. It is an OTC company, and it's quite thinly traded. But simple, easy to understand business model, strong profitability from current operations, visible growth plan, and a great track record for success. So profit margins may fluctuate a little bit depending on when they make investments, but it's a story that we like, and it's something that if you're gonna hold it for 3 to 5 years, then we think that it's gonna produce another excellent return for investors.
Yeah, but I love the way you're doing that, though, and you do that in your service, too. You talk about the risk. I mean, every time anybody thinks of making an investment, they got to say, what kind of risk is this? And you just said, this is higher risk. You know, something else could be conservative, but I love that approach to you. Aaron, I want to thank you for taking the time, and I'll remind people that you've got the big do-it-yourself seminar coming up both in Calgary and Vancouver. Vancouver, it's April 4th. And Calgary, it's April 11th. For information, just go to www.keystocks.com, www.keystocks.com. Aaron, thanks for finding time for us.
Thank you very much, Michael.
I got to take a break. I'm going to come back, though. I've got a shocking stat. Maybe you won't be shocked. I think, well, it's a stat you should be aware of. That I can guarantee you. Plus, I just put out the challenge just a few minutes ago. Ozzie Jurek will be with me very shortly. What do you think the fastest growing real estate market in Europe was? I'm just saying flat out, you ain't going to get this one. Plus, I got Drew Zimmerman joining me live from the trading desk. I got a good Goofy Award, so all of that's coming your way. So stay with us right here on the Money Talks Network. Coming up, I got a Goofy Award for you. I call this, it's a serious Goofy. This is something we should all be aware of. I've been talking a lot, and I'm proud to say I have, about the curtailment of free speech and free expression. Well, this is a Canadian story on this, and a major Canadian story that I want you to be aware of. That's coming up before we're done here. We got live from the trading desk with Drew Zimmerman. Plus, you got to answer the question, which market in Europe do you think was the hottest real estate market in 2016? I'm just telling you, you ain't going to get this answer right. But time now for this week's shocking stat. Now gather the children around, because I say that because I'm talking about how much debt is going to be racked up by the federal government that they'll have to pay back. This coming fiscal year, that's 2017, begins on April 1st to 2018, the federal government is going to spend $25.5 billion more than it takes in, but they also have a $3 billion contingency for a projected deficit of $28.5 billion. Here's an interesting one. The federal government's going to issue $142 billion in bonds this coming fiscal year in order to finance the growing budget deficit. That's a new record, by the way, about $7 billion beat last year. Total borrowing, which includes things like treasury bills and also issuance in foreign currencies, is projected to reach $286 billion. But keep in mind, $247 billion of that is required to refinance existing debt. So, all those numbers coming at you. Total federal government debt is going to increase to $665.5 billion this coming fiscal year. But you've got to keep in mind, that is not the total story. Right now, when you total up all the provincial debt, it's greater than the total federal debt. Ontario alone, they're on their way to $350 billion in debt over the next 3-4 years. I mean, we're going to have deficits at the federal level running into the foreseeable future, averaging about $23 billion over the 5 fiscal years. Now, there's going to be lots of debate over whether deficits of this size are good or bad. The country certainly can afford it. I mean, our debt to size of the economy, called the debt to GDP ratio, is far better than most Western nations, way better. But it doesn't mean it's a good idea to borrow. Let's not confuse the two. It's just like yourself. You can maybe be able to afford the spending, but it doesn't mean it's good spending. I mean, it totally depends on where the money's spent and how effectively. That's why I get worried when I hear all this talk about, oh, we can afford it. Well, that still doesn't justify spending. And we can give you every week examples of where you shouldn't be spending that money. I mean, sorry, Prime Minister, but your trip to the Bahamas over Christmas cost the taxpayer $127,000. I would have thought, by the way, that all parties would at least agree that it's incumbent upon government to spend the money efficiently and effectively. It doesn't matter if one party thinks we shouldn't have a deficit, another twice the size of deficit or debt, whatever. But couldn't we agree that we should spend it efficiently? But sadly, yes, they have agreed, but not on that. They all support, every party supports the status quo. We've got a monopolistic structure of government that has low accountability, most times no performance measures, no cost-benefit analysis, no incentives. I mean, the most recent numbers came out of the 147 programs already in existence for innovation and skills training, 2 really popular buzzwords right now. We spent about $22.6 billion on it. Well, my goodness, we found out that the vast majority have no performance measures. We have no idea if that money is well spent, if we got value for the money. As I say, there can be a big political debate about how big government should get, what areas it should be involved in. But I would have thought we could get agreement that whatever areas they're involved in, they have a duty to spend the money effectively, especially a duty to our children who are getting saddled with this, at the very least. But that is not the case. And you shouldn't be fooled by that. Their system today guarantees more ineffective spending, more spending that they don't know whether it's effective or not, and more waste. I'm going to take a break. I'll come back. I'm going to answer that question, which European market was the hottest housing market. We're going to take a look at the global story, because I'll tell you, it's not just Canada that's talking about hot housing. It's global. We'll do that with Ozzie Jurek when he comes back. We're going live to the trading desk in just a couple of minutes. You're just moments away from that. Drew Zimmerman will join me. You're something like 10 minutes away from my Goofy Award this week, but right now I'm joined by Ozzie Jurek on the line. Ozzie, I want to get right to it. I issued the challenge if people could guess what the hottest housing market in Europe is. And I think I can give them 10 guesses they're not getting this one. So I know you know the answer, so share it with us.
Well, the funny thing, of course, that this particular country saw a housing boom from 2002 to 2007 with prices surging by 70%, and then prices absolutely collapsed by almost 40% from 2008 2010 because it had extreme exposure to the global crisis. And, of course, the place was Iceland.
Yeah. And let me just say that. I don't think anybody's got that one down pat.
But the thing
hey, let me just say this, Ozzie. Sorry, one of the things you've been talking to us about for ages is that you said, it's the biggest unreported inflation in history. We get our official CPI number, and then you, of course, are following real estate, not just in this country, not just in the States. You're looking at it globally, and it tells a very different story. And that's what I wanted just to get a moment to get at this moment is, you look at the globally, you got real estate moving in a ton of markets.
Well, it's mind-boggling, and you're quite right. At every Outlook conference for almost 15 years, I've made the point that we don't put in our inflation basket the core inflation, headline inflation, anything that you and I buy, rent, government services, healthcare, food, you name it, anything that I go out and buy doesn't go up by 2% a year. I feel sorry for somebody earning $40,000. He goes to his boss, and the boss says, "Here's your increase. It's 2%." That's what the government says is inflation. And then he goes shopping, and nothing goes up at 2%. And particularly on the hard asset side, when we create money out of thin air, and that money competes with the money you and I earn, then that settles down in hard assets. And man, go across the globe. China is still the best performer, but only in the tier 1 and tier 2 cities. 72 cities in China had price increases last year, but they were all in the big markets. Hong Kong is higher. Japan is higher. In Europe, Germany is higher. Romania, Ireland, Estonia. I mean, this is a house price index from Global Property Guide, which is sort of a really interesting report, because the only thing that's depressed are those economies that have a terrible economy, like Russia. Yes, it saw a price plunge by 9%. But everywhere else, whether it's the United States, isn't a single house in the United States that hasn't risen in prices. And I'm happy to say that the winners in the United States are all cities that we recommended on this show with you, Michael. And that was Seattle is now the winner, and Phoenix, and then Tampa, and so on. But all of them are rising far beyond the official inflation rate of 2%.
You know what was one of the things, though, that sort of took me back was certainly Iceland did. I wouldn't have guessed that one myself. Romania's done well, that kind of stuff. But here's the thing. When I'm reading an article that tells me that Europe is being super vibrant. And at first I went, really? And then I realized, of course, you got negative interest rates and zero mortgage rates. And I guess that's what's done it. But Europe has been, or at least several areas of Europe has sure experienced what you've just described.
Well, and I think I said it for years, that the big money is running away. They're fleeing their collapsing economies or currencies, and now the big money is really scared to death about the euro. You have pointed it over and over again, the importance of the elections in Europe and the general dissatisfaction everybody has with the government. Well, if you had €2 or €3 million, where would you go? And that's why we have German industrialists hitting Vancouver, paying $432 million for the Royal Centre. Or when you take a look at Iranians buying West Vancouver, or the Montreal condos being bought by Germans, or the waterfront, the money around the world, 8,000 millionaires, you and I talked about before, came to Canada last year. 82,000 are on the move worldwide, and they're coming. Canada is now rated one of the third largest in the world in order for safety and safe banks and so on. So we're going to actually see more foreign money, but it may not necessarily be Chinese money.
Okay, I want to skip gears just for a second, Ozzie, because we got the federal budget, and the last week and the week before you were saying, hey, you know what, look for changes possibly to how they tax your primary residence if you've had a home office in it. We didn't see that in the budget. Do you think it's still coming, though?
100%. We say it will definitely be coming. It's too scary to put it in now. But remember, it's already really there. It is just, it's never been enforced. Look, the first clue that is coming is that they make us report it. The second clue is that they put in $40 million to StatScan to really make sure that we do it. Then they go after tax evasion. And then look at private residences, the capital gains. They're drooling the idea that they can get a part of that back by simply accounting for your office in your home. So I'm absolutely convinced that it's going to be a tax grab. In fact, the minister said so in the House, that there will be an exemption to the exemption, but it wasn't in this year's budget, so you're going to be okay with your tax returns, but I wouldn't hold my breath.
And that's also what they've been doing in so many other areas. As you said, this is on the books, but it hasn't been enforced. As you say, they put in, $40 million for more enforcement. Every year they put in more money, and I think you're going to see a much more aggressive federal government through their Canada Revenue Agency. So I'm really with you on that. Hey, let me end on something more cheerful. Got a hot property for me.
Well, the hot properties, what I'd urge people to do is go to Craigslist, go to the real estate section, go to assignments. And under assignment or assignments, currently there are almost 80 properties by owner where the owner wants to assign the property. And I would look for somebody that has 5 or 6 that he wants to flip. He's probably starting to get worried that he needs to close. And you might just pick up a good deal in assignments when you look in there. There's also realtors that are advertising them, but I like to shop where assignments are that owners post.
Interesting stuff. Ozzie, we'll chat with you next week. For more information, just go to Jurock.com, Jurock.com. Ozzy, what are you doing this weekend, by the way? Very quickly, are you skiing? Are you golfing? Who are you torturing?
I don't like to tell you that I'm doing because you always raise my golf game, and I'm golfing out there.
Oh, my gosh. Spring has really sprung if Ozzy Jurek is out there golfing. Everyone be warned. Have a great weekend, Ozzy. I'll come back live from the trading desk. You're just a couple of moments away from my Goofy Award. I'll get to that just after I go live to the trading desk. Very pleased to welcome back Drew Zimmerman, PI Financial. Hey, Drew, I was just looking at the markets this week. Maybe I was a little focused on the federal budget, et cetera, but what jumped out at you?
Well, Mike, we had a 1.2% down day in the S&P on Tuesday. Now, that might not sound all that crazy, but what is crazy is that was the first time we were down more than 1% in 109 trading days, the longest stretch we've seen in over 20 years.
Well, and as you well are aware, I mean, we've seen so many predictions of corrections in the market coming literally, I mean, since about the third day of Mr. Trump's election when the market had already moved a ton, but it hasn't really manifested. Excuse me. How do you sort of look at that and say, is this the beginning of a correction or not, or is it a warning sign, or you ignore it, or it's an opportunity to buy? You know, how do you make sense of it?
Well, like I say, that the 1.2% in itself isn't a big move, but it is the market psychology, the sentiment that had been built up from the Trump election. The market was pricing in that we had this deal-maker president. We had a full Republican Congress. We had the animal spirits, which was another word for confidence in the markets, all being priced in, all being brought forward on things that he was going to do that were going to make America great again. It was going to be a lot of spending. It was going to be tax cuts. So now that we've brought all that forward into the price, the market is looking at it and saying, are we not going to get all of that? Are we not going to get it as fast as we thought we were going to? So we may have run up a little further. We always like to look at market psychology as a pendulum, and we think it's really been pulled forward to one end, to one extreme, and we now may see it fall back. I'm not looking for, a huge drastic crash in the markets, but the sentiment has probably gone a little too far on pricing in everything good that could happen in the next couple of years.
I think that's a terrific point to make, is that, we've already priced in the tax breaks. We've already priced in a regulatory change, and the infrastructure spending. All of that's in the market, and really there's only one direction for that. It'll be hard to surprise the market positively. It may be more tepid than they expect, so that's a negative. Let me come one more thing very quickly here. I know you've been short the crude oil market. You've been saying, I don't like crude oil. I'm looking at the production. Just give me your take on crude right now.
Well, exactly, Mike. We know the fundamental story is there. And again, this week, we had rig counts jump 21. So that's an indication that the shale plays are still profitable. And from that, we have U.S. production continuing to go up. We have U.S. inventories, again this week, at all-time highs. These are huge fundamental issues with the oil market. And we see OPEC just isn't able to cut enough, and they would be really giving up a lot of market share and really starting another war, kind of like we saw in 2014, a war on prices, I should say. So there's just so much oil out there, I really don't see how we stay above $50.
Well, good stuff. So you're still short oil, short the Canadian dollar, all of that stuff, steady as she goes. Drew, thank you for finding time for us this weekend. Appreciate it.
Thanks for having me on, Mike.
Drew is at PI Financial. You can find him there in Vancouver. Time now. Oh, by the way, thanks to Drew, but thanks to all of my guests. A reminder that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment, meaning you get paid first. There are no fees attached to it. It is in the tech sector. For more information, go to soleraclub.com. Time now for this week's Goofy Award. Well, anyone who's paying attention to this show is going to notice the relentless attack on free speech on university campuses. I mean, so-called controversial speakers. People like Israeli Premier Netanyahu, Ann Coulter, Ayan Hirsi Ali have all been prevented from speaking on university campuses. You got professors who don't adhere to the latest progressive dogma. They're targeted. As Stanford University Provost John Ashmendi stated earlier this month, outlining what he sees as the greatest threat to universities, said specifically, in quotes, intellectual intolerance, a political one-sidedness that is the antithesis of what universities should stand for. It manifests itself in many ways, in the intellectual monocultures, that have taken over certain disciplines in the demands to disinvite speakers and outlaw groups whose views we find offensive, and in constant calls for the university itself to take political stands. Well, that's the context for this week's Goofy, which goes to McGill University, who pressured well-respected academic, I'm just thinking this, Andrew Potter, to resign his post or be fired as director of McGill's Institute for Study of Canada. It's the Institute of Study of Canada at McGill, because of a contentious article he wrote for Maclean's magazine. The university issued a statement stating that Mr. Potter's views didn't reflect the university's views. Well, a Stanford provost said, a university's role does not include having views. Instead, should promote the exchange of ideas. It shouldn't make any difference if Mr. Potter's views are popular with the Quebec intelligentsia or McGill's donors or Quebec nationalists. Universities aren't there to promote a popularity contest, to promote a consensus view, or to avoid uncomfortable questions. But McGill has done just that. I mean, how can the actions at McGill not result in self-censorship among its faculties? Because they don't want to run afoul of the McGill Star Chamber. But this is another major flashing red light when it comes to freedom of thought, freedom of speech. It's a massive black mark on McGill University that I think casts a pall over universities throughout Canada. That's this week's Goofy Award. And by the way, a reminder, go to MoneyTalks.net. You can get the latest updates on the business comments. You can go and get the latest articles we got there. We got a ton of good stuff on the dock this week. But I hope you also go and visit us on Michael Campbell's Facebook page, Money Talks Facebook. Go to that. Be a regular there. We post on a daily basis, all of that for you. So in the meantime, I hope you go out and have a terrific weekend. Thanks for listening.